Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers. It's Friday, March 20th, 2026, and we're diving into some fascinating market insights from yesterday's social media chatter and AI-generated analysis.
That's right, Ethan. Yesterday was a whirlwind, with a significant amount of posts flagging a diverse range of stocks.
A lot to unpack, especially with some major geopolitical events stirring up certain sectors. Let's not waste any time and get right into the specifics. All right, first up, let's talk about Cheniere Energy Inc., LNG. Our analysis, drawing from multiple discussions, shows an overwhelmingly bullish sentiment. Users are pointing to immediate geopolitical events, particularly those affecting Qatar's LNG output, which is creating a global supply shock. They're seeing huge short-term gains, $50,000 in 2 hours type of action, and expecting even more upside. The company's financials, like strong EPS and revenue growth, definitely support this. This stock has consistently been a buy in our previous ratings, and with this news, it seems to just reinforce that.
Well, Ethan, while the market is certainly riding a wave of enthusiasm for LNG, we can't ignore the high debt-to-equity ratio of over 200. Yes, the net profit margin is robust, and insider buying, a significant 4.88% net purchase, is a strong vote of confidence. But the news mentions it's entering overbought territory, which from a KPI perspective suggests that some of these gains might already be priced in. However, the projected multi-year crisis in supply does have the potential to significantly improve future revenue growth and net profit margins, making its current PE of 11.68 look quite reasonable for future earnings.
I hear you on the debt, Brooke, but the tailwinds from soaring natural gas prices and that strong insider confidence are hard to ignore. For LNG, our speculative analysis lands on a buy. The fundamental picture, propelled by current events, looks very strong for sustained performance. Next, let's turn our attention to Sandisk Corporation, SNDK. This one has been quite a roller coaster. Users are talking about incredible rapid gains. Some even saw 1,000% returns on options. There's a lot of FOMO out there, and some analysts have even upgraded price targets to $875. The stock has been up an astounding 1,200% in the past year, and it's showing strong revenue growth. Ethan, I've got to pump the brakes on SNDK. While the social media buzz is certainly high, and yes, the stock has had a phenomenal run, the underlying financial KPIs are screaming caution. We're looking at a negative net profit margin and negative earnings per share. The company isn't actually making money on a net basis. Plus, the price-to-book ratio is an astonishing 11.18, and its debt-to-equity is nearly 8. These metrics, even with positive revenue growth, suggest massive overvaluation and significant financial risk. Our previous rating yesterday was speculative gamble, but frankly, the deeper dive into these fundamentals pushes me to say that it's just too stretched. That's a fair point, Brooke. The hype is certainly real, but the financials are a concern. For SNDK, despite the user optimism, our AI-generated insights lead us to a stay-away verdict. All right, let's talk Home Depot Inc., HD. There was a post betting on puts because housing is cooked, but the community actually pushed back strongly. They argue that if people aren't buying new homes, they're investing more in renovations on existing ones. It's a classic contrarian play, with users highlighting the company's resilience even through the pandemic. Plus, there's positive news about new store openings and strategic initiatives like AI tools for pros. Our previous rating for HD was stay away.
Well, the community's contrarian optimism for HD is interesting, but the KPIs present a different picture. The stock is currently trading very close to its 52-week low. More importantly, we're seeing negative revenue growth of nearly 4%, which contradicts the idea of a thriving renovation market right now. And Ethan, the debt-to-equity ratio is a staggering 510. While insider buying is a positive signal, that level of debt is a serious financial risk, especially if economic headwinds persist. Those new initiatives and store openings are promising, yes, but they haven't translated into positive revenue growth yet.
Okay, that debt is a significant red flag, Brooke, even with the long-term strategic plays. For HD, our market commentary suggests a stay away. We need to see that revenue growth turn positive. Moving on to Novo Nordisk AS, NVO. There was big news about their Wegovy HD receiving FDA approval, which you'd think would send the stock soaring. They're expanding into Japan, too. NVO has strong profit margins, and there's a massive market for obesity treatments. Our previous ratings have been quite mixed, sometimes a buy, sometimes a speculative gamble.
And yet, Ethan, the sentiment on social media was largely negative and sarcastic. Users reported losses, and many felt the good news was priced in, with the stock even dropping post-announcement. From a KPI perspective, the stock is trading near its 52-week low, significantly down from its high. What's more concerning is the negative revenue growth of 7.6%. This means that even with blockbuster drugs and FDA approvals, sales aren't currently expanding. While their profitability metrics were strong, without top-line growth, it's hard to justify a bullish stance, and the low PE might just reflect this market skepticism. Our previous rating was speculative gamble, and the current sentiment combined with negative revenue growth definitely pushes it lower.
It's tough when good news doesn't move the needle, isn't it? For NVO, our AI-generated insights lean toward a stay away for now. Next, let's look at Microsoft Corporation, MSFT. A user made a bold 12K options play, expecting the stock to hit 550 or 560. Microsoft is an AI powerhouse, a tech powerhouse, and it usually gets a buy rating from us, including our last rating. Ethan, while Microsoft is an undeniable titan, the community sentiment on this particular aggressive options play was overwhelmingly bearish. Users were quick to point out that a 40–45% jump in a few months for a nearly $3 trillion company is an enormous ask. The stock is already trading significantly below its 52-week high, and the PE of 24.33, while fair, would be stretched far higher by such a rapid move. There are also discussions about high capital expenditures on AI potentially tempering short-term EPS growth, and we've seen net insider selling. The news even mentions Microsoft's worst start since 2008. I mean, it's a great long-term company, but betting on such a rapid, dramatic short-term surge seems incredibly risky. Our previous buy rating for the long-term stock needs to be reassessed for such speculative plays. You make a very compelling argument, Brooke. While I'm bullish on Microsoft's long-term future, that specific short-term target does seem unrealistic. For MSFT, for new aggressive positions, our speculative analysis suggests a stay away. Now for Deutsche Bank AG, DB. This was a YOLO bet on puts, with the user predicting an energy crisis, emerging market defaults, and DB being the second domino.
The community sentiment on DB is intensely bearish, Ethan, and the KPIs back it up completely. The price-to-book ratio is a concerning 0.60, meaning the market values it less than its assets. Even more troubling is the negative revenue growth of nearly 19%. Users are calling it a truly awful company that's terribly managed. Plus, it's never been rated on our podcast before, and this initial look is quite grim. With an upcoming earnings report on April 29th, users are predicting ugly results, and given the negative revenue growth, that seems highly probable. This is a classic example of a stay away.
Yikes, that's a pretty strong consensus. For DB, our market commentary is a definitive stay away. All right, let's talk about Royal Caribbean Cruises Limited, RCL. The original post was very bearish, predicting the cruise industry would get buried by Middle East conflicts. However, the community strongly pushed back, arguing that RCL has robust fuel hedging strategies and uses heavy fuel oil, which isn't as impacted by those specific conflicts. It seems users believe RCL is resilient, and it's never been rated on our podcast before.
Ethan, while the community's arguments for RCL's operational resilience are well articulated, the financial KPIs present some serious headwinds. The debt-to-equity ratio is an extremely high 215. Cruise lines are capital intensive, but that level of debt introduces significant risk, especially if interest rates remain elevated or if consumer discretionary spending faces pressure. Even more critically, we've seen significant insider selling, over 1.2 million shares net sold in the last 6 months. While the stock has seen a good recovery since its COVID lows and revenue growth is positive, that insider selling combined with the massive debt suggests caution. It tells me that those closest to the company might see limited upside from current levels.
That insider selling and debt are indeed substantial concerns, Brooke, despite the positive operational news. For RCL, our AI-generated insights lead us to a stay-away verdict. Finally, we have Fundrise Innovation Fund LLC Common Shares, VCX. This just listed yesterday, promising access to private tech like OpenAI and SpaceX. Users reported massive initial gains, with one seeing 50K turn into 250K. There's a lot of excitement about the scarcity angle for retail investors. This is a new one for our podcast.
Ethan, this is a perfect example of hype potentially overshadowing fundamentals. The stock quadrupled on its first day, which is wild, but many users quickly flagged it as an exit liquidity event for existing private investors. They're asking, why do they need retail if these companies are so great? There's also the crucial point that there's no transparent free cash flow for the underlying private companies, and comments suggest it's trading significantly above its net asset value. Plus, there's a 6-month lockup period expiry looming for those original investors, which could flood the market with shares. It's too speculative right now, fueled purely by scarcity and excitement for names, not clear underlying profitability.
You know, that exit liquidity argument is hard to ignore, especially with the lack of transparent financial data. For VCX, our market commentary is a stay away. All right, Brooke, let's wrap up our hunt for today. After analyzing all that data and social media chatter, here's our compiled list for deeper analysis. Investigate as buy, Cheniere Energy Inc., LNG. Investigate as cautious buy. None. Investigate as speculative gamble. Sandisk Corporation, SNDK.
And that brings us to the end of today's episode.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll be back next time with more AI-generated insights to help you navigate the markets. Have a great weekend, everyone.